Hello and welcome to all who have been able to join us here virtually for one more of the webinars in the Jamnabai Narsee education series. These have been designed particularly for our parent community by the three Jamnabai Narsee schools under the umbrella of the Narsee Monji Educational Trust. The intent was to help our parent community largely, and we realize now that the reach has been wider than that. So the intent was to help our parent community further strengthen their mental, physical, emotional, and spiritual faculties while we are all undergoing this unusual experience of the lockdown. To Mr. Sujay Jairaj, we owe particular thanks for envisioning how this is going to be of particular benefit to us during this time. Without any further ado, I'd like to introduce to you our moderator for today, who in turn will introduce the prominent speaker and his topic. The moderator today is Aditya Madnani, an alumnus of Jamnabai Narsee School of the ISC batch of 2017. Aditya is currently pursuing his undergraduate studies at ISME and is studying the Business Management and Entrepreneurship program. He currently holds the position of Student Council President, which comes as no surprise given how we've seen him wear multiple hats with ease. In late 2017, he launched the Alpha Urbane Project, a youth leadership organization that gives leadership opportunities to several middle and high school students. Aditya also organizes the Jamnabai Model United Nations. Without any further ado, over to you, Aditya.
Thank you so much, Ms. Sonali. Thank you, Mr. Sujay Jairaj, for giving me the opportunity to moderate such an esteemed speaker today. I'd like to introduce to everyone Mr. Ajeet Khurana, our esteemed speaker for today. Thank you so much, sir, for joining us and taking out the time. Mr. Khurana is a serial entrepreneur and venture capitalist. He's a former faculty member at a top US business school. Mr. Khurana has set up business multiple countries and has held the position of CEO multiple times. Most recently, Zep. An educationist himself, I'm sure his thoughts will resonate well with the parents and students attending this webinar. Thank you so much, Mr. Khurana, for joining us. And we're all very excited to hear about your thoughts on new age entrepreneurship. After
My
Mr.
pleasure.
Khurana, thank you so much. After Mr. Khurana speaks about the topic, we'd encourage the audience to send in their questions, which I will then ask Mr. Khurana. Thank you, sir. Over to you.
Just to understand, what are the timelines that you're looking at? How many minutes and stuff?
We'd love for you to speak for about 30 to 40 minutes, and post that, we'd love to entertain questions from the audience.
So what I'll do is I'll be a little shorter than those 30 to 40 minutes. Let's call it 20, 25 minutes. Are you able to hear me, Aditya?
Yes, you're absolutely clearly audible.
Very
Yes,
nice.
sir.
Okay. So today we are talking of new age entrepreneurship. And, the reason we put the topic as new age as opposed to just entrepreneurship, there's a specific reason for that. For instance, businesses have been set up for, I think, as long as human beings have been around. So setting up of a new business by an individual, hence called an entrepreneur, is nothing new. What has changed in the last, I would say, 10 to 15 years, which is, it has caused a societal change, it has caused an economic change, and very much has it caused a change in the career opportunities that await our children, is the fact that we are looking at a new type of entrepreneurship. And I want to talk a little bit about the old type. I'll spend like just 2-3 minutes because that is largely obsolete. And then I'll tell you about how entrepreneurship works today. I did my MBA between the years 91 and 93. So I'm quite a ancient MBA degree holder to that extent. And at our point also, there used to be people, organizations, institutions who would encourage entrepreneurship. But the nature of entrepreneurship was very different, and entrepreneurship was largely seen as an esoteric opportunity because business houses used to be relatively bigger business houses. Three things changed very dramatically over the last few years. Number one, is that the internet became available to everybody who wanted it. The internet was around even in the early 90s, but it was a very rare thing. Number two is that mobile devices made the internet not just available to you at one place, but wherever you went, and with great ease of use by just tapping your screen. And number three is that people with lots of money, whether you call them angel investors, venture capitalists, or investors in general, became more keen and more risk seeking than ever before. So, for instance, some of you must have read in that over the last week or so, Jio, that is Mukesh Ambani's Reliance Jio, has been selling shares to first Facebook and then one or two other entities at a valuation of about $65 billion. That means Reliance Jio, one of the largest organizations, corporates in India, has valued itself at $65 billion US dollars when it has sold shares to investors. While this is a matter of pride and good that Indian economy is receiving investment, but the fact is that if you look at some startups that have been started over the last few years, let's say the last decade or so, started by people with no business background or business family, are today valued at numbers even greater than that. And some of those are doing things which, compared to the infrastructure level thing that Jio does, is seems very simplistic. For instance, one of the world's largest manufacturers of semiconductors, which means those integrated circuits, those chips that are put into all electronic devices, is a Taiwanese company. And it manufactures 50% of all the integrated circuits or chips that are put into computers, mobile devices, etc. If you look at the value of that company, which produces this hardware, and you compare it with, let's say, the value of Netflix, which a lot of us are consuming quite heavily in this lockdown era, well, the valuation of Netflix is higher. What is happening is that whatever was our basic understanding of economics, that has changed significantly. For instance, when I was a student of pursuing my MBA at the University of Texas, we had VCs that we talked to, VCs, venture capitalists, who we visited and wanted to see if they would invest in our business. While what I'm telling you is about 28 years old, here is the interesting change in mentality that has occurred related to investments as well as entrepreneurship. Is that at that point of time, if a venture capitalist were to invest in your business, they would first want to make sure that you as an individual have put in all your money, all your savings, and if you have any assets such as a home, that you've taken a loan against that home and also put that money in. Basically, if you have put absolutely everything in, then they would be keen to invest along with you because they knew that your skin is fully in the game. In addition, when they would invest, they would own more than 50% of your business, thereby being able to control the business in case you do not perform. Both of these characteristics have changed dramatically over the last 30 years. And now venture capitalists are happy if you not just do you not put everything you have into your business, but actually from the money that they invest in your business, you actually draw a salary for yourself, which is very interesting. And secondly, if they today say that if you have really put everything and you have mortgaged your home and put money into your business, then you will probably become very risk averse and constantly be having a survival struggle. So they actually are fine with you being comfortable. In fact, in Silicon Valley, which continues to be the birthplace of many great startups in the Bay Area in California in the US, it is said that an entrepreneur who fails actually is far better to invest in than an entrepreneur who has succeeded earlier. Now that might sound counterintuitive, but there are certain psychological reasons to believe that that might be true. So what does all of this mean? For instance, take the case of one of India's most valuable entrepreneurial setups called Flipkart. We've all heard of Flipkart, quite likely we have used it a few times. This was purchased by Amazon a couple of years ago for, if I'm not mistaken, $20 billion. Now, what is interesting is that the two founders, both of whom have the last name Bansal, coincidentally, when they started this company, not even a decade ago, or maybe about a decade ago, what happened was that they started selling books online. At that point of time, many of us were not accessing the internet. Several of us did not have email addresses, though people in business, all of them tended to have it at that point of time. And mobile devices, while they existed, were not so much in the form as we have today, where you just keep tapping on your screen with Android, iOS, etc. Now, starting from a point where they were selling only books, in the period of as little as a year, we reached a point where this company became so valuable that the world's largest retailer came and purchased it in India. If you go back to, let's say, my parents' generation, uh, uh, for your reference, for those of you who can't see me on screen, I'm about 50 years old, 50. Such a thing was largely inconceivable. A growth within a decade of going from zero to such a large number, unless I believe one would be, let's say, in the business of crime of some sort. I don't know, and that too, I'm not sure it would happen, but it is conceivable at least. Today, what has happened is that we have had so much growth in our economy. And when I say our economy, I'm referring to the global economy. And a large part of it has been driven by central banks, such as Reserve Bank of India is a central bank of India, by central banks all over the world printing a lot of notes, which means when the government has to spend money, it can, of course, hope to be productive itself, as the oil producing companies are, or the public sector companies are in India, or it can collect the tax very effectively and spend that money. Governments do both of these things, but when they have a shortfall, they eventually resort to what is called a monetary measure of printing more money. Because if you tell people to give you more money in the form of tax, people tend to evade it. Instead, if they can print more currency notes, what tends to happen is that now the government has money that it can spend. I'm making this a little simplistic, but in principle, it remains true all the same. And effectively, what happens is that everybody who has money, let's say we have Indian rupees, and the government goes and prints 1 lakh crore of Indian rupees to deal with the coronavirus situation, well, the rupee will depreciate, and the value of the rupee that all of us have will go down. Inflation will occur, and in a sense, the government would have taxed the entire nation in a way that nobody can evade or tax plan away. Because central bankers have been resorting to depreciating their currencies by infusing more money into the system again and again and again, what has happened is that even if you are earning a certain rate of interest, for example, Indian banks would give you like a 6-7% rate of interest. Maybe if you took a greater risk and loaned out money to your friends, etc., you might make more than that. The problem is that the rupee, or for that matter, the US dollar, Singapore dollar, euro, or what have you, is depreciating at such a high speed that you are having to, be on an economic treadmill, and maybe you have to run fast just to stand at the same place. What this has led to is this entire sector of very highly speculative investments, where people will try to, invest in movies, art, wine. I have a friend who invests in whiskey. Some people will invest in exotic jewels, gems, etc. And some of the other people who are used to investing in companies or corporations will say, why should we wait for a company to get listed on a stock exchange, such as the Bombay Stock Exchange or the New York Stock Exchange, before we invest in it? Why don't we invest in it sooner? Just to draw an analogy for those of you who may not be familiar with the world of equity, suppose you were to buy an apartment, a flat in Mumbai, and hold it for a decade or so. I don't know if we will see similar appreciations that we have seen in the past, but people who purchased it in the early 90s or people who purchased it in the late 2000, let's say 2007, 2008, actually have made a significant amount of money. For instance, people who have purchased property in the vicinity of 2005, probably, depending on where they have purchased it in the city of Mumbai, might even be looking at an appreciation of 5 to 10 times, depending on whether it was commercial real estate, etc. Now, the interesting thing is, what if your requirement of returns are greater than that? By the way, I must point out that anything that I'm telling you that has happened in the past is not necessarily going to happen in the future. So please do not take this as any form of investment advice. And of course, some people may have had a different investment return than the ones I'm talking about. But if because of your portfolio targets, you require a higher return than this, and you want to invest in real estate, sooner or later, somebody will tell you, don't go and buy an apartment or flat. Just go and buy land, build your own building, and sell those flats. While this is easier said than done, but the economics of it is very interesting. If you were to actually buy land and then invest in the cost of construction, in the same period that you may have, let's say, purchased an apartment and sold it for 5 times more, if you start from land assuming you can go through the entire rigmarole and all of the practical limitations around it, there's a good chance that if the apartments are now sold, your return will be much more. So what did you do here? You basically entered the real estate game a little sooner. Instead of buying a finished product in the form of an apartment, you purchased raw land and then built apartments upon it. A similar example, when you are investing in the share market, would be that don't wait for a company to become so big that it goes and lists on the stock exchange. Invest a little before that. What is little before that? Well, the company is pretty big, and probably someday soon will get listed on the stock exchange. The moment that becomes attractive, then the natural slippery slope of economics will say, hey, invest a little before that and a little before that. And it will go to a point where actually we will see a scenario where people are investing in a company at the time the company is taking birth, right? And that is what has given rise to entrepreneurship. Of course, the business models that we are seeing in these entrepreneurial ventures tend to be very new age themselves, related to the internet, making mobile apps, moving offline businesses online and the like. And this supports the entire investment into startups. Now try to understand this whole thing from a very different point of view. We have, and I think not in the recent past, not in the last 1.5 months, but we have all used the Uber app to book a cab. As we know, Uber is a very valuable company. It's listed on a stock exchange. People think that the stock could be priced maybe higher, but it is still many tens of billions of dollars. Let's try to understand what Uber does, how it does, and try to understand new age entrepreneurship with that example. So taxi cabs have been around for a very long time, decades. People who travel in taxi cabs obviously were there at the same time, because that's how the business of taxi cabs came about. So it could be that I'm standing at a particular corner of a road, street side, and I'm waiting for a cab, not able to find any. And just 2 roads away or a block away, there is a taxi driver who is sitting with an empty taxi and is not finding a passenger. If somebody could matchmake the 2 of these, well, then that would be marriage made in heaven, because I would get my cab and the cabbie would get the rider. Along comes Uber and does exactly that. I don't want to explain how Uber works because all of us know it. Now, what you want to understand, and this is the beautiful thing about technology as it has emerged, is that what did Uber really make? How does Uber know where the taxi cab is, and how does Uber know where I, the rider, am? This technology, which is the GPS technology, was not developed by Uber. It was not purchased by Uber. It was not rented by Uber either. Uber got it free of charge from Google, who owns OpenGPS. So what has also happened technologically is that today it is possible very easily to actually build upon the technology that others are using. For instance, right now we are using Zoom. Now, because we want several people, a very large number of people, to come into this webinar, this is a paid account of Zoom that Jamnabai Narsee School is using. But otherwise, every one of us can use Zoom to some extent with some number of participants and for a certain duration free of charge. Which means today what has happened is that the way technology is being consumed or presented to people is that largely you can spend almost no money. Like, come to think of it, if 2 of us right now used a WhatsApp call or a Zoom call and talk to each other for 10 minutes over a video conference scenario, we might pay as little as just a few rupees, like even as little as like 10 rupees, and get done with a proper video conference lasting like 10 minutes. That is a very low cost. And you have to wonder how it is that the entire internet and the voice over internet protocol and all of those things went about, and how could this entire thing be afforded in 10 rupees? The reason this entire new economic paradigm around technology has come is because today people and organizations are facing 2 trends which probably didn't exist earlier. Number one is that they are willing to give a lot of stuff away for free with the hope that you will build upon it and someday you will become a big user of it, and after that you will end up paying for it. Pretty much like I said, that we could be using Zoom software, but then when I want many more participants or for longer duration Zoom conference calls, then I might be happy to take a paid call. Google has a database related product called Firebase. Those of you who are in technology have definitely heard of it. And it is available, if you want to use it a little, it is available free of charge. The previous company where I was CEO, what I found was that over time, though we started using the free version of Firebase, over time we became the world's largest consumer of Firebase, In fact, Firebase, the developers of Firebase contacted us and would try to help us become better users or optimal users. So I said there are two things. Number one is that organizations are today willing to let you use their product free for to some extent, so that when you become a bigger user, you will be addicted or used to or in the habit of using that product, and at that point you'll start paying them. And there's a second very interesting phenomenon which has some examples going back decades, but largely it's a new phenomenon, that the consumer and the customer are often different people. This is extremely important to understand to appreciate what new age entrepreneurship. The word customer and consumer usually has been regarded as the same word, but just to separate the two, the customer is the person who pays you money. Whoever pays you money for your product or service is your customer. The consumer is the person who consumes the value of your service. So for instance, you go to Google, the search engine, and you search. That means now you have consumed the search service offered by Google. So you are the consumer of Google. But we never pay Google money, right? I mean, we just use Google free of charge. We have been using it for like 2 decades now. So who is paying Google? When you use Google, the search engine, when you're looking at the search results, you're often shown advertisements. Those advertisers are paying Google. So in this situation where I was describing Google, you, the people who use the search engine, are the consumers, and the people who are buying advertisements become the customers. A similar analogy could be obtained for those of you who are, my age plus or minus 10 years, is when radio was very popular, going back to the 70s and probably some part of 80s also. At that point of time, if you had a radio set, you could hear the radio as you can today. But you never paid the radio company anything. Like today, if you're using radio FM, Mirchi, Star, whatever radio channels are there, you don't pay for those. Unlike TV channels, where several channels we pay for radio channels, we are largely not paying. So we become the consumers of the radio service. People who advertise on the radio channels become the customers. Newspapers classically, nowadays you and I are like really starved of newspapers, but newspapers classically have been selling newspapers for a price which tends to be same or even significantly lower than the cost of production of the newspaper. Because again, you are the customer and consumer of the newspaper, while the advertisers are the customers. So while examples like newspapers and radio existed a long time back, today, because of the way technology has emerged, so very many companies have found a way to aggregate audiences, not charge them anything, but charge somebody else. For instance, I think absolutely everybody on this call either regularly use or has in the past used WhatsApp, the messenger. Now, when WhatsApp started a long time ago, and those of you who got into WhatsApp way back, you know that, I don't know if you remember this, but when you signed up for WhatsApp, it said that, it is free for 1 year. And then after 1 year, they would charge us $1, which was between 52 to 56 rupees at that point of time. And some people who started on iOS in the earliest versions of WhatsApp may actually have paid $1 or $2 for 1 or 2 years. But eventually, WhatsApp became completely free. It was free even earlier, but some people, for a small window, must have paid a fee. Now think about it. If somebody asks you what is the worth of using WhatsApp, I would say, personally, I would be willing to pay a few hundred rupees a month for it. However, if WhatsApp indeed levied that fee, I would also simultaneously go and check, are there other messengers which most of my friends are using, which basically are similar like WhatsApp and don't cost me anything, right? So both these things would happen. Now, with the fact that, like 1 billion people, I don't know what the exact number is, but it's a very large number. A very large number of people are using WhatsApp around the world, and WhatsApp charges you nothing. And here's the interesting thing. WhatsApp is also not showing you any advertisements at this point of time. And until very recently, it had no revenue model at all. If you think about it, how was WhatsApp making money? WhatsApp was making money, not too much of it though, I must say. WhatsApp was making money by, at taking the data that you were using and selling it to company who could make use of that data. Again, it was not selling your private data. For example, we still don't receive the sort of spam messages on WhatsApp as we have been receiving on email since forever, and over the last several years, even over SMS. Right? I'm not sure what the future holds, because obviously it's business models of private companies that we are talking about. But the fact is that WhatsApp, solely because it aggregated so many users, when it was sold to Facebook, it was sold for such an extremely high price, as all of you know, right? As in, to put an Indian number to that, when WhatsApp was sold at the dollar rate at that point of time, it was around 1,20,000 crores. As in, if I convert the dollar amount to the Indian rupee amount. And interestingly, this company had no revenues or close to no revenues at that point of time, right? So this model where A, on the one hand, the customer is somebody else pays you money, while somebody else consumes your value. And B, the fact that today there are investors available who are willing to subsidize your loss as long as you are growing, aggregating audiences, creating market share with the intent that in the distant future, now distant future is not hundreds of years, but probably like 5, 8, 10 years later, then in the distant future, you will make adequate money so that you make a profit. Sometimes this goes so far, as in the case of WhatsApp and many other such examples, that you will even not make revenue. For example, Twitter made no revenue for the longest time, and many people were using it for what is called microblogging. Several of us have used Twitter, and still the company was doing well economically because investors were supporting it. So, emergence of technology, mobile devices, a dramatic change towards entrepreneurship in terms of mindset and attitudes. The distinction between customers and consumers, as well as the availability of investors' money and the investors' ability to bear risk. These are some of the drivers of new age entrepreneurship. This talk can go on forever. I said I would take a little less time. So let me just wind this up by saying that when I was a student, I was a student of engineering. After that, I did my MBA, and somebody was helping me prepare for the entrance interviews because I had got calls from some of the top institutes after their entrance exam. And, so one of the questions that I was being prepared for is, okay, so what will you do after an MBA? And my answer was, immediately after an MBA, I will set up my own business and become an entrepreneur. And I was strongly discouraged from giving this answer. And they said that, if you say this to these management institutes, they'll say, then why do you need an MBA at all? Go and become an entrepreneur. Instead, you should give some sort of corporate aspirations or something which is more mainstream. I don't know whether that was the truth even at that point of time, but nobody would even dare give any advice of this sort today. I have helped a lot of students get admission to MBA programs as well as undergraduate programs in the US, more on a friendly basis, like neighbors' children and the relatives and those kind of things. And I must tell you that what I have seen is that universities love it when you tell them that you want to be an entrepreneur. So this attitudinal difference, which even in my life I have seen, because for instance, my dad was employed till a very, very old age, till his mid 70s actually. And when I started my career after my MBA, I got a call from one of the top, I would say 15 industrialists of that time, who personally called me and invited me to head one of his business divisions. This call was arranged by a mutual friend. And I told him in return that, no, actually, I have decided to set up my own business. And my dad was in the same room when he heard that call. And he said, do you know who you were talking to? I said, yeah, I said, I know who I was talking to. He said, how could you say no if he's calling you to head a business unit that he's setting up? I said, because I want to set up my own business. And my dad was so mad as to how stupid I was that he didn't talk to me for many days and tried to get my mom to put some sense into my head as to how can you be so stupid? Give up these childish dreams of setting up your own business. So, well, that rings a little too close to home, at least for me. But in general, I have seen a significant change of mindset. So those are some of the drivers and characteristics of modern day entrepreneurship. And they are hence a little different than we have seen in the past. So Aditya, would you want to come and get these proceedings going?
Absolutely. Thank you so much, sir, for that talk. Very, very insightful. If I can please request the audience to start sending in their questions through the Q&A box at the bottom of your screens. We've already started receiving a few, so if I can start shooting them towards you, sir. The first question that we have actually received is, for someone with a good corpus, what is the process to identify potential startups and then monitor their performance?
Okay. So I must, before I answer that, and it's something very, very close to my heart, because I have been an angel investor since 1998 when I invested in a .com called Padai.com. From 98 to 2010, I invested approximately in one company a year. And these were people I knew either directly or one step removed. And from 2010 to 2014, I became very active as an angel investor, working with other angel investors, not working individually. In 2013, I was listed as one of top 15 angel investors in India. Now, to answer your question properly, what you need to do is you need to answer one question before that. Are you seeing startups as a professional activity of yours, or are you seeing startups as an asset class? This is very important. For instance, gold, real estate, stock, and there are so many other asset classes where basically you put in money, and over time you hope to increase this money. That is classically investment. A professional activity would be that you would invest in a startup, and then in addition to putting money into that, you would also help them grow. Now, helping them grow could be something as simple as, giving them your economic or business wisdom, or it could go so far as to help them get customers, get them tie-ups, help them set up abroad, a lot of the help them hire, make connections, etc. So if you are looking at something just being an asset class, namely all you want to do is put the money and wait, as opposed to being a professional activity where you will help the company succeed, the answer to your question becomes substantially different. If you are looking at being a passive investor, I would strongly advise against investing companies which are very, very young, like which are at the seed stage, idea stage, just getting started, or not even having developed the product yet. Because what tends to happen is that companies at this stage globally, and very much so in India, have huge mortality rates, like mortality rates exceeding 90%. So let's say 95%, which means 1 in 20 companies succeeds. Now imagine how well that one company would have to do if 19 of your companies have failed, right? Just as an example, suppose you were to put, and I'm just giving very simple numbers, 1 rupee investment in 20 companies, right? And 19 of them fail, but that last one, which did so well, became, I'm actually, this is the worst thing when, you get a phone call during your Zoom call, which actually is going on. But well, I'm glad this did not take away too much. But what I was saying is, so you invest 1 rupee each in 20 companies, 19 fail, and the last company does phenomenally well. It becomes 100 times in 10 years, or in 5 years, it becomes 100 times bigger, right? But if you think about it, you put in 1 rupee into 20 companies, so you invested 20 rupees. The last company, 1 rupee became 100 rupees. Effectively, for the 20 rupees you invested, you got 100 rupees back, right? Now that is a 5x return in a 5-year or 10-year. Not bad, but people have made similar returns in the stock market also, right? And the kind of risk you took where so many companies failed, I don't know whether it was worth it. Because what if the 20th company had also not succeeded? Or what if you had invested in 7-8 companies, see all of them fail and then stop, namely lost all your principal? So what I would recommend is that if you're investing in the very, very early stage, it is not a very suitable place to invest as a passive investor. There are exceptions to this. I'll list one exception. So sometimes there are things called accelerators, incubators, and other such platforms. For example, one of the world's most famous business accelerators is called Y Combinator, right? So Y Combinator comes up with Y Combinator funds. Y Combinator companies are considered on the whole a little above average compared to other startups. And then if you put it in their funds, so effectively you're getting some sort of an index return. Again, I'm making this very simplistic because this is not a very deep investment seminar, but based on what I'm saying, you could just do a few Google searches and get the exact answer. By the way, I myself am an investor in 3 of the last batches of the Y Combinator fund. And by the way, in each batch, sometimes they have more than one fund. So I was invested in 4 funds the first time, 5 funds the second time, and 6 funds the other time. So I'm invested in 50 funds, all of which invest only in Y Combinator companies. Y Combinator is a platform which helps startups grow. Move to the other side. If you think you can help companies, namely now, as startups are not an asset class for you, rather startups is a professional activity for you. Here, I would strongly advise that you get in as soon as possible. So for instance, if you think you can help a lot in the technology or the customer acquisition or the hiring or the international expansion or what have you, you should enter right at stage 0. In fact, you should go out and look for an entrepreneur. And if you are sufficiently convinced that this entrepreneur is good, enter early, because with a small amount of money or with no money, you will be able to get into a partnership and own a significant chunk of the business. The downside here is that yes, you will now have to participate in the executive or the operation of the business. So I think at the model level, I'll answer the question. There was one part as to where do you find these companies? Well, I'll give a shortish answer because it's an infinitely long answer in reality. So there are only 2 ways, primary and secondary. Primary sourcing is when you go out, you let people know that I am an investor, you participate in online forums such as LinkedIn, etc. And then people start reaching out to you and you engage with them, You develop your own thesis, you develop your own style of working and choose your own. The second one would be where you join groups. So there are a large number of these angel networks, investment funds, etc. There are online platforms, like one of India's largest one is called Let's Venture. Globally, one of the largest one is called Angel List, and there are so many others, where what happens is that these platforms source deals for you, and then they present it to you. Sometimes, for example, I was member of a group called Mumbai Angels, I think a really good angel investment group, for 4 years between 2011 and 14, 11, 12, 13, 14. And every month they would present 4 startups to us, who would come and stand in front of us in a conference room in Worli in Mumbai and pitch to us. And they would also take care of all the paperwork, etc. So either you can do primary sourcing by yourself, reaching out to entrepreneurs, or you can do secondary sourcing where somebody has helped you do the process. Right? Both have their pros and cons, and you will develop your own style. Slightly longish answer, Aditya, but it was a very deep question. Aditya, I must also tell you, you also feel free to ask me any questions you have, because as I don't know, the headmistress of Jamnabai Narsee introduced you, but I must point out that I have known Aditya now for some time, I think about a year, maybe a little more than that. And Aditya is actually a very good example of this new age entrepreneurship that we are talking about. He became entrepreneur immediately after 12th standard. While, you might think of examples like a Dhirubhai Ambani or somebody where, people did start from very adverse circumstances, but those were 1 in a million situation. But I increasingly see that now, to be an Aditya, you don't need to be 1 in a million. You probably need to be like 1 in 1,000. So that's 1,000 times improvement. And Aditya, I congratulate you on being a young new age entrepreneur. So I welcome your questions also.
Allow me to interrupt here for just a moment.
Yes,
may I? Yes, Jamnabai Narsee is extremely proud of this young alumnus of ours. And it's for the reason that we recognize his entrepreneurial ability, is why he is requested to moderate this session, which he's doing so well. Sorry to interrupt you both, and over to you again, Aditya.
Thank you so much. Thank you so much, sir. I promise you there are going to be a lot more questions from my end that I'm going to keep sending your way. So thank you for that. We have another question from an investor's point of view, where what would you value more in a startup as an investor? Is it the digital enhancements in technology, which would be the main key, or is it tangible assets with heavy capital investments?
So I think this question is very easy. I'll give a very short answer. The answer is number 1. Very simply because when I invest in companies listed on the stock exchange, I don't use this criteria. But given the very high level of risk that I am taking while investing in startups, I have found that capital heavy, asset heavy businesses, they tend to have a natural friction as to how big they can become in a reasonable period of time. Given the example I gave you of investing in 20 companies and 19 failing, I must tell you that despite everything, I also have this track record of so many companies that I invested in which became zero, right? So the ones that succeed have to do so well that I have found that digital businesses tend to do better. Having said that, there are all sorts of examples. Right, Aditya, your business is not a digital business, but it has done exceedingly well. It's one of the examples that I give to people when I talk in public. And there are other examples in health. There are examples in agriculture. So in fact, one of my earliest positive returns actually came from an agriculture business. So while there are all sorts of businesses that can succeed, but as a category, I tend to stay away from asset heavy and capital heavy businesses. I must just now take a little tangent for everybody. There is this concept of business model. As in, if I set up a business, you set up a business, why should the business succeed at all? The question is, what is the model you're following? So for example, O2O over the last decade has been a very popular model. O2O means offline to online. So we would go to a movie theater, stand in a queue and buy movie tickets. Now we do it on Book My Show or several other platforms. We would talk to a travel agent 20 years ago who would give us an airline ticket. Now we do Make My Trip, Yatra.com, Clear Trip, etc. So this entire thing, likewise, you stand physically and order a cab. Now we click on an app. So fundamentally, airlines existed even before. Movie theaters existed even before. Taxis existed even before. So the physical component has not changed. What has changed is how we are consuming those. So the last decade has seen that the greatest business opportunity was channel shift, namely from the offline channel to the online channel. Then when you saw the Red Bus, Make My Trip, Oyo Oyo rooms or Oyo, whatever they call themselves, or Ola, Uber, etc. These are the aggregator models. What happens here is that there are enough hotels, but Oyo says, I'll bring them on one platform. There are enough airlines, Make My Trip brings them to another one platform. Uber brings cabs to one platform. So this is the aggregate model. Red Bus brings buses to one platform. So the aggregation model is also another model. There are various business models, and what you need to do is firstly convince of the model. Right? For example, take the case of selling online. That's the e-commerce model. Until very recently, by very recently I mean maybe 5 years ago, groceries just could not reasonably be purchased online. Many people tried and failed. Now today literally every one of us is sitting at home and consuming groceries. So you have to identify what business model you like. Within that, you have to see whether the timing is right. Within that, you have to see whether the market that they are addressing is big enough. And finally, the most important, whether this person who you are investing in, the entrepreneur, is the right entrepreneur. Right? So that is how I choose.
Thank you so much for that. And given the fact that in the year 2020, things aren't going exactly how we planned them to, with this pandemic all around us, a question from an entrepreneur's point of view as well as an investor's point of view is this the right time to start something new as an entrepreneur? And as an investor, what sectors of startups would you suggest that one should invest in?
So this particular topic about startups dealing with the COVID-19 situation, I have done, I think, about 12 webinars over the last 15 days. So what I'm saying is that this is of great interest, and hence a question that is very valuable. I think startups that started many years ago and largely are established are feeling pain, but they are likely to survive it. The worst hit are people who started in the second half of 2019 and got invested into, started scaling up really big and have suddenly hit a pause. They are the ones that are going to be the worst hit. But your question is somebody who wants to start up today. Now, I think that is not such a bad position to be in. For instance, if you look at the 100 most valued startups in the world today, and you look at when they started, I think greater than 50% of them started at an economically slow period. Of course, we are not just talking of a slow period, we are talking of almost a paused or hyper slow period. So it may not be probably an apples to apples comparison. But having said that, what is the need of the hour for any business? I think there are 3 needs of the hour. Number 1 is to be very, very, very stingy in spending money. So a startup which is born in an era where money has to be spent very carefully actually is going to get good habits right from day one. Number 2 is using the power of relationships. By relationships, I mean relationship with customer, vendor, employee, landlord, all of these people. Using the power of relationship to tide over impossible economic situations that arise, as opposed to just spending money left and right and growing. So I think that, again, a startup which is born at a time when relationships are the key to business success is going to do well. And third, even if you're stingy, even if you have great relationships, it doesn't mean that you are going to get away with being successful at business unless you do something dramatically creative. Right? I'll give you an example. So that's the company which I used to mentor. Just by the way, companies in the past and the present have given me advisory equity because they value my advice or my participation as being as valuable, if not more, than any capital I could bring in. So one of the companies where I'm an advisor is in the business of education, and he was about to close a investment round around January when this COVID-19 situation exploded in his face. So he did something very simple. He just went to all the customers, and his customers tend to be students and their parents, and said, listen, this is our situation. You know us. Can you just pay us the next 2 years fees in advance? And here are all the things we'll give you in return. And because of the creative approach as well as the relationships, I, by the way, am also his customer, not just his advisor. So I very happily agreed. And now he's smoothly sailing while others are struggling to make 2 ends meet. Again, we can always give examples of every sort, and it is not as if everybody is in a position to survive this problem. But I think that on the whole, if I may again present some arithmetic, let us take an industry. Let us take the real estate industry. Let us compare December 19 versus December 20. If we find, for example, that the size of the business in December 20 is half of December 19, which means the entire real estate market has been cut into half. Let us assume that is the case. But now you look at all the participants in the real estate business. It's not as if all the participants have become exactly half. In reality, many participants should just have shut shop. So those have gone from 100 to 0. So if the industry has gone from 100 to 50 on a whole, and several participants have gone to 0, that means there are some who have not done so poorly. What I'm trying to point out is that it is going to be very difficult, but there are some things working in your favor. And the biggest thing, the greatest positives that startups are facing today, and you must be wondering, how is there a positive? The positive is that if I go back like 13 years, 2007, we were facing an opposite situation, the availability of reasonably priced talent. So if you want to hire decent employees today, because of the economic scenario, a large number of them of very high caliber are available at an affordable price. I remember when I was actively helping people with their businesses and an entrepreneur myself in the year 2007, it was an impossibility to get employees. You would hire somebody, they would not show up for their first day of their job because they had gone somewhere else. They would have taken your offer letter and gone to somebody else and got an offer for double the price, etc. So I think that that is definitely a silver lining. The second thing is that there are some areas, which answers the second part of your question, which seem to be doing well. So for instance, edtech, education tech businesses transmitted over the internet are doing well. For example, later today, I think, or tomorrow, there is a company that is trying to pitch an investment opportunity to me, which over the last 6 weeks has grown 30-fold. They're in the area of English language training on the internet. And a young company, like I think just barely about 8 to 9 months old, but they have done in the last 6 weeks what they have not done in the many months, multiples of that. So certain businesses may do well. Having said that, the quality and the quantity of the lockdown is unknown at present. What I mean is, I don't know how long it will continue, and I don't know how stringent it will be, because currently we are at a phase where, we are getting a little more relaxed. And if this relaxation continues and life someday becomes more or less normal, things will be very different than if we started getting relaxed and suddenly there was such an outbreak that we again went into an extreme clampdown, like a complete curfew. So I don't have any prediction on that. But a lot of people are predicting things like, the fact that commercial real estate would suffer, that work from home will become the new normal, that, health related startups would do well, that producers of personal protective equipment would do well. I am not entirely sure that regardless of circumstance, these are the complete truth. But for entrepreneurs, this is the time to place the bet. You have to bet whether this becomes the new normal. So for instance, academic institutes which have to overnight start conducting classes online. So all of us who have children or are associated with schools, colleges, etc., saw that academic institutes really had to struggle, as in they went through all sorts of trouble. Exams, especially the global exams like the A levels and all, the exams got cancelled. Cambridge, just cancelled the exam because how would you conduct it? So I think that if you predict that this is now the new normal, there are going to be a lot of opportunities that you can bank on because of the new normal. At the same time, you could predict that, this is soon to blow over and it won't be the new normal. We will be back to our old ways. In that case, you take that view. See, the entrepreneur takes a view of how the world, how the customer will work. And depending on that view, the entrepreneur makes an offering. This is the right time for that.
Thank you so much. I think that perfectly sums up the question that I had asked. Another very interesting question is, again, with the post-COVID era, India is now tending to be a manufacturing hub for the world, and a lot of people will shift their businesses out of China and to India. Well, at least that's the general perception that all of us are reading about. So manufacturing, which is generally an asset-heavy business and capital-intensive, how would VCs now look at that? Because just a few minutes ago, you said that personally you aren't a fan of a manufacturing-heavy business. Would your view still be the same if India does shift to become the manufacturing hub for the world?
I'm going to begin by assuming that this shift from China to several countries such as India is going to actually fructify, as opposed to be something that is being talked about. I'm not entirely convinced of that, but then the debate becomes very different. So I'm going to begin by assuming that is the case. Now look at it this way. There are innumerable startups which are in the manufacturing sector. One startup that I had worked very closely, which even like Madura and other Birla Group companies became customers of, was in terms of optimizing wastage and storage. Likewise, there's a startup which I think is either already a unicorn. A unicorn is term we use for a startup which is worth $1 billion or is thereabout. It's called Grey Orange, which is in the area of robotics, which are used for inventory management, etc. So it isn't as if manufacturing has not been touched by the startup world. For example, a lot of drones, a lot of satellites, where very heavy equipment are involved, satellite-related startups, drone-related startups, artificial intelligence-related startups, optimization, robotics, and very soon artificial intelligence will also find its way deep within. I think that these are all ways to grow, optimize, and scale manufacturing units. I'll give you one very interesting example. I was a resident of Singapore for 1.5 years, ending March of this year, when I rushed back to my family in India because I was worried otherwise God knows when I'll see them again. But many of us have traveled to Singapore. And if I ask you, okay, what did you see in Singapore in terms of commercial activity? Some of us would have seen a lot of tourism happening. Some might have seen real estate really flourishing. And say, no. Tell me about the manufacturing business in Singapore. And a lot of us would say, no, we didn't see any real manufacturing. And say, Singapore is so tiny that, many of us have crisscrossed Singapore so many times. The fact is, Singapore has a very strong manufacturing base, except most of it is close to fully automated. Like just imagine like very, very large industrial units being operated like by 20 people, where, in another country, it might be 2,000 people. So I think that definitely there is a room for startups to operate in the manufacturing sector. Now, am I saying that startups will start manufacturing themselves? Not necessarily, because we are all part of the integrated system, right? For example, Uber doesn't own any car, Oyo doesn't own any hotel, but they are very much the biggest players in cabs globally and the biggest player in hotel in India, at least. In light of that, I think that at least at the border, as enablers, startups will exist. Will startups get into physically manufacturing machines, as an example? I must tell you that venture capitalists are not the only type of investors in the world. If you look at investors as a whole, investors have always been investing in tangible, essential, asset-heavy businesses. It is that venture capitalist economic model does not support that, right? So I do not see venture capitalists or angel investors as an asset class moving into manufacturing, unless, it was like very highly scalable, digital, low-value objects. But I do not see a challenge at all in availability of investor capital for manufacturers, just by a different segment of investors.
Thank you so much. We really bombarded you with a lot of questions that you answered very, very well. And I'm sure we've all gained a lot from this session. So I'd like to thank you personally, but would like to invite Ms. Sonali and would like to hand over proceedings to her so that she can propose the vote of thanks.
Thank you, Mr. Khurana. Your inputs were very, very comprehensive, so relatable. Like you yourself said, that very simplistically expressed, so that the analogies made it so easy to understand what you were trying to say. I was particularly tickled at how your eyes were twinkling at the mention of the unconventional route you followed after completing your MBA. And I can only understand, I can only imagine how lucky the youngsters have been who have been mentored by you. So thank you for spending some of your time with us and sharing these very insightful points with us today. Aditya, you've been a wonderful moderator as always. I once again repeat, we appreciate the kind of leadership skills you have, the kind of entrepreneur you already are. And thank you for introducing us to Mr. Khurana and making this webinar possible.
Thank you so much.
Thank you once again to Mr. Sujay Jairaj, who facilitates these webinars. I mean, it was sheer vision on his part to understand and realize how much people will benefit from these. And we've been lucky to have had a variety of topics that have catered to myriad interests, be they to do with finance, leadership, science, global crisis, nutrition, spirituality, and whatnot. We will continue to bring more webinars to you. And may I point out that we had an attendee who commented on the fact that entrepreneurship should be introduced in the school curriculum. And it makes me very happy to let you know that while it may not be a formal subject within the school curriculum, there are opportunities galore for our younger and older students to put on their thinking caps, to prove themselves to be good entrepreneurs in big and small ways. I mean, as leaders who take on the responsibility to organize events, as students who shoulder the responsibility to arrange for, opportunities whereby community development can be facilitated, etc. I mean, I can think of many examples, but I don't want to take away the focal point from today's webinar. But rest assured, knowing that at Jamnabai Narsee, we are constantly honing the latent skills that our young entrepreneurs have. Have a great day ahead, everyone. We look forward to your participation in our future webinars.